Where are the markets headed next? To learn more, I'm joined by Kathy Jones of Schwab. Kathy, thank you so much for joining me.
Oh, thanks for having me.
So, very big question to answer. Talk to me about your economic outlook, particularly your expectations for the labor market and inflation.
Yeah, so we're looking for the economy to slow down a little bit in 2026. And it's been pretty sturdy in 2025, but it's been kind of a two-tier economy with higher income folks doing better and continuing to spend, big companies investing in CapEx, particularly for AI. But then you get down to lower income folks or small and medium sized businesses, they're not doing as well. Tariffs have had an impact. And in general, there's, some of the policy changes have made it difficult to hire and keep workers. So we're looking for this two-tier economy to give way to a little bit slower overall in 2026. Not a recession, but a bit of a slowdown.
I was going to say that quells some fears here a little bit. So, you don't think any type of recession is looming in the future?
It doesn't look like it. We follow a bunch of indicators that would give us a sense of whether a recession's coming, and they're not flashing red. There's some yellow, but not a lot.
Okay, so hopefully that eases some minds a little bit going into the new year. But what's your outlook for Fed policy in the year ahead?
Well, the Fed has two mandates. One is to keep the unemployment rate low, and the other is to keep inflation low. And so right now, those two are in tension. Inflation's stuck at about 3% and starting to nudge higher. Unemployment is starting to trend up, although it's still quite low. I mean, by historical standards, 4.5% unemployment is not bad by any means. So they're in this tension now because job growth is slowing down. They did cut rates in anticipation of slower growth there, but they're stuck with inflation at 3%. So we don't think they cut again this year. We think maybe in the new year, if we're right that the economy slows down a bit, we'll get probably 2 rate cuts next year. But that's about the maximum the Fed can do. The market's expecting more, but unless inflation really comes down, they're going to have the policy rate sitting right on top of the inflation rate, and that actually stimulates the economy and inflation. So they're pretty much stuck until inflation comes down.
And from an advisor perspective, what conversations do you recommend they have with their clients going into the new year to, again, maybe alleviate some of the pressure that their clients might be feeling?
I think the good news is that fixed income is doing exactly what it's supposed to do for clients right now. It's that boring part of your portfolio.
Boring is good, though.
Boring is good. It's generating income. It's providing capital preservation. And there has been positive total returns. There's been some price appreciation. Every sub-asset class we follow in fixed income has had a positive return year to date, and some of them really strong positive returns. So if you're managing the portfolio to have income without a lot of volatility, core bonds, meaning treasuries, other government-backed bonds, investment-grade corporate bonds, investment-grade municipal bonds, you're in good shape. And you just take the coupon income, reinvesting it, and you should be in good shape in 2026.
All right, we'll end it on a positive note then. Kathy, thank you so much for your insights.
Thank you.
For wealthmanagement.com, I'm Shannon Rosic.